Hello, and thanks again for joining. This week's video is going to be part 3 in our very basic overview of investing series. Specifically, today's video is going to be how to invest. But for today, we're just going to focus on the very general, broad question of how to invest. So the first thing to start with is to understand there's many types of investments. What I'll be speaking about today and broadly in general is a very small range of a whole wide universe of types of investments. On this slide, you can see you have stocks, bonds, certificates of deposits, cryptocurrencies, retirement plans. There's a whole bunch of stuff on here. Real estate's not included on here, but you could include that. Private placements, limited partnerships. So there's a huge wide universe of investments. My opinion is that the universe is too broad and too wide and paralyzes people into inactivity. And so what we really want to do is find what are the right types of things to focus on learning about for us in our unique position. For most people below a certain net worth, we want to focus on a much narrower range of investments. But even within that, at different phases in the journey into accumulating that net worth, we're going to want to focus on a much smaller range of investments. Think of it like taking bite-sized pieces of this puzzle and then growing your education and your knowledge over time so that you can add more investment tools into the arsenal. So today I'm going to talk about a few specific types. So the broad question of how to invest begins with understanding what you're beginning to invest in. For most people, we'll be investing through our employer-sponsored retirement plan or through our own individual brokerage or trading accounts. Those have the lowest barrier to entry in terms of the amount of cash you need to invest in order to get access to investment markets. They're also highly liquid, so you can get your money in and out pretty easily, and they're not complex to actually manage or use. So to begin, specifically talk about individual securities, which are stocks and bonds. These are the investments that you might commonly associate with things like the New York Stock Exchange or the stock market or the S&P 500. Within those bigger buckets titled the stock market or the stock exchange or the S&P 500, you have companies that sell a percentage of their equity or their ownership to the general public. And these are super micro small amounts in the form of a stock. Or if you're a government, like the US government or California state government or a municipal government, you sell bonds, which are IOUs or debt. And these are traded in easy manner through the stock exchange or through different brokerage accounts. And so the highlight here is it's very easy to do. It's highly liquid and easy to get access to these investments. But the challenge is that it's hard to do well. You have to start thinking about, what do I buy? Which stocks, which companies, or which bonds, which states, which governments? What do I pay? What is a marketable price for that? How do I know? If I don't pay attention all the time, how do I know what the right price to pay is? When do I buy? Like when? Is it the right time to buy now, tomorrow, a week from now, a year from now, a year ago? When do I sell? And then how do I diversify? I don't want to put all my eggs in one basket. Diversifying is the process of investing into a series or a range of different stocks or bonds so that if one company or one government performs poorly, all your money doesn't go down the tube. All right, the second type of investment we'll cover today is mutual funds. Again, very broad level. We'll do a deeper dive on these in the future. Mutual funds they are pooled investor money. So what that means is there's a person, a professional investment manager who starts a business that does in professional investing. He goes out and selects companies and bonds, or he or she goes out and selects companies or bonds and buys a portfolio of these things. And then you or I, who are not experts in investments, can then go and say, hey, I'm going to place a bet or invest in this manager. I'm going to put my trust in this manager and say he or she knows better than I what to invest in. So I'm going to invest in this manager's company. I'm going to buy ownership in this fund. And that fund's performance will mimic or track the performance of what this man or woman invests in. So many different investors that are less educated or less informed can benefit from kind of attaching themselves to this professional investor. And usually this professional investor will have a company called a mutual fund, and they'll have a stated investment objective. It'll be composed of many different stocks and bonds, among other things, that diversifies the risk. And it usually has a fee associated with it, either a front-end sales fee or some kind of ongoing fee or some kind of combination of both. And the hope is that the trade-off of paying the fee for a professional full-time investment manager will actually produce reward that will be better than what you could do or I could do on our own. It's easy to get access to these. They're traded in brokerage accounts. We'll go through that in, again, later day, very briefly later. But this is a very common way to invest that takes the onus off of you or I as individuals. Finally, we have what are called exchange traded funds. And these perform exactly or very, very similarly to mutual funds. They're traded like stocks, meaning you can buy a portion of this fund's company, but that fund company has its own portfolio of stuff that it buys. The fund company's value or performance mimics the portfolio that it invests in. And these are passively managed instead of actively managed, so different from a mutual fund in that the mutual fund is an active manager, full-time focusing on trading the individual investments within that mutual fund to try to get performance for their investors. ETFs are passively managed. They don't have that full-time person who does it. The investment objectives are similar to mutual funds in that they try to diversify across many companies. They're trying to facilitate individuals like you or I being able to invest in a broader portfolio when we might not A, have the expertise or B, have the money to buy 200 different companies. The benefit of an ETF is that the fees are much, much lower than mutual funds. Now, there are some trade-offs in terms of what you get out to, which they're a good tool. And again, I'll go into a deeper dive into each of these things at a future date so we can go through the pros and cons of them. Last but not least, all of this takes place. So once you're evaluating the types of investments, now you have to think about where do I do the investing? And this is done within specific account types. So this is just a quick slide with 4 examples. You have brokerage accounts, which is a certain type of brokerage account, refers to the taxation of that account. And again, we won't go into detail into that, but examples might be Robinhood or Wealthfront or Charles Schwab account or a TD Ameritrade account. Then you have employer retirement accounts. That's your employer's retirement plan within which you make contributions and then the investments take place in there. And those might be 401ks or 403bs, 457s. And the thing to notice here is, or to note here is that employer retirement, all these different types of accounts that I go through now will have different types of investments available within them, a broader or narrower range or volume of investment vehicles. Then you have individual retirement accounts like an IRA or a Roth IRA. There are many different types of IRAs as well. And then you have self-employed retirement accounts like a SEP IRA or a solo 401k. And the thing here is, once your job is not done once you just start to learn about the types of investments. Now you also have to learn about where those investments take place. What are the tax implications? Why is one account better than another? Am I limited to using certain types of accounts? Should I not overlap types of accounts? And you'll see in future videos when I do deeper dive that these factors actually matter and come into play. And so to wrap up here, the summary is this is a good place to start, and if you haven't seen the other videos I've made on investing, you should. Each of them are about 10 minutes. There's one called 4 Things to Consider Before You Invest Your Money, Stop Rushing to Invest. The second one is the what, where, and why of investing. And then this one is how to invest. And you can see that the picture is not simple and it will require some time and effort. If you ever read the book, The Millionaire Next Door, that's a common thread. People who achieve millionaire net worth status typically have invested a lot of time and attention into learning about investments because they want to understand, even if they delegate those activities to a professional, they want to understand what they're participating in. Anyways, hope this was helpful. Again, inviting you to submit comments or suggestions on future videos. If you like the trend, please leave a comment and a like on this video on YouTube because it helps other people find my videos. And it also tells me if you like the topics I've chosen that I can keep pursuing these topics and adding more depth to it. Thank you so much.